Great pleasure to have our amazing pool of speakers today. Joe Scalio is the senior partner in charge of tax at KPMG and lead of the Opportunity Zone practice. KPMG is our tax advisor in full disclosure for the Opportunity Zone Fund. Kunal Shah, managing director and head of research at iCapital Network, which works with financial advisors to connect them to managers like us. And Jimmy Atkinson, founder and CEO of Opportunity DB, which is an online network of investors interested in real assets, alternative investment strategies. And Jimmy produces an amazing content for all the alternatives, and particularly Opportunity Zones. If you haven't seen his blogs and webinars, do check it out. So with that, if you guys want to say a few words about how you came to this, that would be great. And then we'll get into the substantive discussion about regulation and any updates that there are to the policy. We'll talk a little bit about manager selection and the criteria that go into selecting investments. And we'll talk a little about the landscape. Jimmy will start us off just talking about how much has been invested in the space, where is it going, which markets, which strategies. So with that, why don't we start with Jimmy, and if you want to say a few words about yourself, but really focus on the big picture of Opportunity Zones.
Sure. Excuse me. So I'm Jimmy Atkinson, founder and CEO of Opportunity DB, as Peter just mentioned. I founded Opportunity DB in 2018. I learned about Opportunity Zones right after the zones were designated in July of that year, and I went to the internet immediately upon first learning about it, because I thought, this sounds like a great program, I want to learn more about it. And there really wasn't a lot of information about it. Probably some really geeky articles maybe written by Joe or some other accountants or attorneys, but there wasn't anything that was directed at the retail high net worth accredited investor. That's kind of my bread and butter, is catering content to that audience. And fast forward 4 years later, I can claim that we're the largest independent media and events organization that is solely focused on the Opportunity Zones industry, and I'm happy to further promote education of what I think is possibly the greatest tax policy that's ever been created, the greatest tax incentive that's ever been created at the very least. So that's a little bit about me.
Yeah, I can go next. So Kunal Shah, I'm a managing director, head of research intelligence at iCapital. We are a fintech platform, so we connect high net worth investors looking for alternative investments through a technology layer where you transact essentially online rather than doing the paper trails and sub-doc processing. We have 11,000 financial advisors signed up on the platform, so we are a B2B business where we directly serve the advisors who serve the end clients, so we don't directly go to the clients. And about 3 or 4 years ago, when the Opportunity Zone first came out, we started looking at it as an opportunity for our clients, right? Which is, we have a lot of wealthy clients who have a lot of gains, and they all should benefit from this really unique and creative program that was introduced. And so that piqued our interest. So we started digging into it. We started building a pipeline. We started understanding the regulation. And we are an existing investor in GTI's Opportunity Zone Fund 1. So we have been part of it. We have underwritten Peter and Tom and the team at pretty significant length, and excited to sort of offer the same product again to them. We are working with them on the Fund 2 right now as well. And we did a lot of heavy lifting on our side to understand how the law impacts our clients, and look forward to discussing some of our sort of findings as well.
Thank you. I'm Joe Scalio. As Peter was saying, I kind of approach this from the tax side, and how I got involved in this is kind of, a little bit interesting. Is when the Tax Act came out in 2017, there were certain areas that everyone wanted to focus on, and then there was this little weird provision back there called Opportunity Zones, and everyone, at least initially, poo-pooed it and treated we've had enterprise zones, we've had empowerment zones, we had all these things. This is just the next iteration of it. And after a period of time, it became clear that this was, not, placing lots of restrictions, but really just where do the dollars go and where do they get deployed. And then, I think as you said, once the zones got designated, people started to say, oh, wow, if I'm going to invest in certain areas that I'm sure Peter can talk about, these benefits can be, availed for my investors. And the answer was yes. So sort of came about, by elimination, that no one really wanted to do it at KPMG. And they said, well, why don't you go ahead and start to do it? And I said, sure, we'll put together a team. And since then, over the last 3+ years, we've put together a national team in different offices and areas. And, we have a leadership team of myself and 2 other people that lead that team nationally, and it's grown. And, we've been excited over the last couple of years. And, I think, this program has been a little bit cursed. It had a little bit of runway before it could come up because of regulations. The final regs came out in effectively January of 2020. COVID hits. But I do think over the last year and a half or so, I've really seen where the program has now got good foundation. It's got good regulations, relatively good regulations. It's got ways where people have all kind of acknowledged in the industry you can do it. So there is a methodology for doing this, especially in real estate. But we've also started to see a lot of companies and tenants start to utilize these benefits. So that's kind of my history in opportunity zones.
And you're having the last laugh, right? Because the program has actually taken off. It's quite large, by magnitudes, larger than some other tax increment
Absolutely.
programs. So why don't we start with a little bit of background, and Jimmy, if you can say a few words on the basics and how it works and how much capital has been raised.
Sure. So, well, first, I'd like to incorporate the audience, if I could. By a show of hands, who here has made at least one investment into a qualified opportunity fund to date? I'm just curious. Okay, so we have a pretty experienced crowd here, so I don't know that we need to belabor the basics too much, but just in case anybody is relatively new to the program. By the way, what I really like about the Opportunity Zones program is that it's a place-based tax policy that's designed to incentivize capital flow into typically underinvested communities. But unlike some of its predecessors, there isn't a lot of bureaucracy involved. There isn't a lot of red tape. It's not a tax credit program you have to apply for or jump through a bunch of hoops. It's really just a framework, I like to think of it as, that sets up this tax advantage. So you have to start with a capital gain, and it can come from any source. Unlike a 1031 exchange, which has to come from real estate, this gain can come from sale of stock, sale of Bitcoin, collectibles, whatever. Within 180 days of realizing that gain, you roll it over into a qualified opportunity fund that then deploys capital eventually into a qualifying investment into a qualified opportunity zone, one or more of 8,700 plus census tract locations all over the country, and including our overseas territories and Puerto Rico in particular. You get access to a handful of incentives. One is you get to defer recognition of that initial gain until the end of 2026. And we'll talk about that a little bit later in the panel because that date might change pending some legislation that's on the table right now. Benefit number 2, it has actually expired, but you did get to reduce the amount of gain that you recognized in 26 by either 10% or 15%. I won't get into the details of that because it takes too long. But benefit number 3 is really the biggest one, is you get to eliminate all capital gains tax liabilities on the subsequent opportunity zone investment after a 10-year holding period. So it's really phenomenal, powerful tax incentive. And, you wanted me to talk about the capital flow. That was the second part of the question.
That too.
Right? So to date, I should also first say, when this program was first rolled out, early 2018, Secretary Mnuchin, the Treasury Secretary at the time under President Trump, estimated that this would be a $100 billion program. And just to put that into context, the second biggest economic development program in the United States is probably the New Markets Tax Credit Program, NMTC. And that program's typically capped at $3.5 billion per year. So already to date, and I haven't even reached the end yet, we haven't even reached 2026, 27, when this thing's gonna sunset and wind down, I've estimated that we've already eclipsed that $100 billion mark based on a handful of estimates that are floating around out there. I don't know if you gentlemen feel differently, or am I in the ballpark?
We agree. Yeah.
Okay, good. So I think this has potential to be much bigger than anticipated. A lot of capital is flowing into the program already, for sure.
Great. You already mentioned the potential extension. It's one of the regulatory questions out there. Joe, what are you hearing about that? And Can you describe what might happen with this piece of legislation?
Sure, I want to go out on a limb and say it's 50-50. So I'm going to go way out there. But I mean, the act has bipartisan support that's been floating around now would do a variety of things. One, as you were saying, would extend the deferral date to December 31, 2028. And by extension, would then allow investors to both get the 10 and 15% benefits for investments that are made in 2022 and 2023. So, you would, if you deferred $100 in 2022, you would only pay tax on $85 on December 31, 28. So we have one, which is pretty valuable when people start to model this out, that 2-year deferral with higher interest rates is, got some juice to it from an IRR point of view. So that's one of the main benefits that we would have in this. The second, one is, they would additionally allow kind of a fund-to-fund structure. Basically now a QOF can't invest in another QOF. And it's just the way they structured it initially. They would allow the pooling of capital from one QOF to maybe invest in another QOF. So you would have potentially, more of like, I think the normal fund-to-fund structure we have. We've struggled with having to create certain mechanisms where we can't invest in another QOF. We have to kind of invest below the QOF into the Qualified Opportunity Zone business. But that, I think, is also going to be, potentially valuable for large investment funds that want to pool capital together and invest jointly. The third thing is they are going to want to put some amount of transparency into this. So right now, there is limited reporting that a QOF has to do, and anyone who's had to fill out certain forms knows the limitation on those forms, which is basically, what zone, what census tract did you invest in, and what's the entity you invested in that census tract. There's really not too more about it, but they would put some more parameters about disclosure and the impact that has on the community. And then they would, which is not a great thing, they would also want to relook at potentially certain census tracts that were originally designated. So there's going to potentially be a redo on certain census tracts. There'll be a grandfathering of investments that occurred, but maybe going forward, future investments would not be able to be done in certain census tracts. And those are mainly around those tracts that meet the definition from an income point of view, generally around the fact that they have, large student bodies there. So the one that always comes up, is technically the area around Stanford University. Anyone who's been out there knows, the wealth out there. But that area around Stanford University technically meets the definition because when you factor in the students. So there will be a relook at certain census tracts to see if they still should qualify going forward. The majority of this would be very beneficial for the industry, especially the couple-year deferral, and especially with the fact that we could have more kind of feeder funds that are created. I use the word 50-50, that this would potentially be out there. Most people believe it will get attached to, and there's a lot of term is called the tax extenders. And that is generally something that happens with bipartisan support at the end of the year. We'll see how the election goes and everything else, but assuming there's some level of bipartisan support and the Extenders Act is going to get done sometime after the election and most likely before the Christmas break, what they will do is this will get attached to it. And both the Real Estate Roundtable and the Economic Innovation Group, seem to be lining up this so that, we're hopeful that it will get passed. And as I said, we're thinking, there's probably at least a 50% chance it will get passed by this year. I'm not sure what you're hearing, but that's
I think I'm hearing the same stuff you're hearing, Joe, because I think we're both in touch with former members of Senator Tim Scott's office. I've been speaking with Shay Hawkins, who actually helped draft the legislation while he was Senator Tim Scott's tax policy advisor, and he's been telling me much the same thing. He says this really does have bipartisan support. By the way, the initial Opportunity Zone legislation had broad bipartisan and bicameral support. That got lost in the mainstream media from day one. In 2018 and 2019, the New York Times and other mainstream media publications unfairly branded the Opportunity Zone provisions of the legislation as a terrible Trump policy that was just helping his real estate friends get rich. And by the way, yeah, it is unapologetically a great tax cut program for investors, that is for sure. That's what it's designed to do. But it does have broad bipartisan support. And the legislation was actually initially drafted while President Obama was in the White House. It took a few years to eventually get pushed through, and then it did get passed as part of the Tax Cuts and Jobs Act at the end of 2017 under President Trump. But Shay seems to think that, because it is bipartisan, it's kind of hard to pass anything too bipartisan this close to an election. This legislation was introduced in April, the reform legislation that Joe just outlined for you. And what I'm hearing from Shay and from others, and what you're hearing as well, is this type of thing typically does get passed after the election day, once the swords get put away. As Shay mentioned to me last week, we were on a Opportunity Zone panel at a different event. And so I think there's a very good chance that it does get passed before the end of the year. Some other people on the panel seem to think that it might still be too politically charged a topic. Maybe it's going to be saved for the Congress in 2023, and that might depend on what the balance of power shakes out to be. So it's speculation at this point. I'm hopeful that at some point down the road we do get an extension, because currently this thing is going to expire at the end of 26 is the last day that you can realize a capital gain and have it eligible for rolling over into an Opportunity Zone fund. So depending on how you accrue the gain, I think you'd have until potentially mid-September of 27. I always have to look over to the tax professional.
September 9th or 10th, depending
Yeah, I think
where the
that's
days
right,
are.
yeah. I've even heard 11th sometimes, too. It depends how you start counting the 180 days after March 15th, right?
Yep.
But yeah, so at that point, the whole thing just ends. So as an industry now, we're trying to push for this to get extended in a permanent fashion, the way that other tax policy programs and tax credit programs oftentimes do over time.
That would be great.
It would be great. And the one thing I will point out is, if there is this, we will, I think a lot of people did not understand the designation process that happened in early 2018, which was really delegated and completely given to the governors. And in this case, if a zone is taken away, a new zone can be designated. So, there probably will be some local and state horse trading that goes on. The other part that I think is kind of a real sleeper in there when this designation process hopefully occurs is there was a lot of zones that when you think about it, and probably more from an industrial point of view in the cities, or maybe where manufacturing was, where they were what they were called zero population zones. And those zero population zones were unable to be designated. So if you think about, somewhere on the Newark waterfront, talk about bipartisan support and Cory Booker's support, there was probably an area there that, could not be designated because no one lived there, or an old refinery where no one lived there. Those areas will be able to be additive and be designated. And, that could be some huge, large development for that community if they're going to turn what maybe was a refinery or a large industrial facility that now could be designated into like a big community or a manufacturing facility or whatever. That is quiet in there, but I do think that's something, if this does go through, could be very important for those local areas to look at. And we've talked to a couple states and localities that, originally said, I wish I could have had a chance to designate this area in 2018. We said, well, you might get a second shot at the apple here to designate it.
I was going to say that would be great. You would get a 15% discount looking back even if you invested last year or this year. But we're not pinning our hopes on it. And partly the reason is we don't get that discount. You do as investors. We really look at this as a real estate investment. And frankly, what we've been doing as a firm for 17 years, when we came to it, we just happened to have a number of projects in these zones, and we figured out it's quite interesting for investors to claim the tax break. Kunal, that theme, really selecting this as a real estate or real assets investment, if you will, you look at a lot of private markets, a lot of strategies. How is this different, and how is it interesting or maybe challenging when you compare opportunity zone investments and manager and investment selection to other private market opportunities?
Yeah, look, there are many factors that goes into that, right? So as we discussed, we talked about the tax side of the equation. There are a lot of benefits from a tax perspective, but it means nothing if the investment ends up being zero, right? And yes, there has been a lot of capital raised, and Jimmy and Joe both talked about sort of $100+ million. So it's a successful program, but you don't see as much institutionalization of the underlying sort of quality of managers or sort of developers, right? And so you don't see large asset managers rushing to raise billions of dollars in this channel. And so from what I see is you have to be careful of who you partner with. Just because there are capital raised and capital has been deployed doesn't mean 10 years later you're going to get a great IRR on that. And so we profess to our clients the first thing we need to focus on is the quality of investment, which is the real estate, and how you go about it. There's a lot to unpack. You obviously have to make sure that you have the tax law completely sort of under your control. You have to manage your deal flow. One of the things that we spend a lot of time with you guys is understanding that the capital is coming in. You have to match the incoming capital to essentially right properties, because you only have 6 months to deploy that capital. And so making sure that you have a very rich pipeline of new development opportunities is critical. Building and creating a structure where it's diversified. Right, a lot of things have gone into one area, which is all multifamily, which is great. But one of the things that we have enjoyed working with you guys is you have done single family, you have done industrial. There's a little bit more diversity across different regions. So, we think that, you have to think of this from exactly the same lens as any other private investment you will make, which is long duration asset, where the quality of the underlying operator and developer is going to be the main thing. And like I said earlier, the tax means nothing if you end up getting nothing, no real investment return. There are other pieces along those lines that sort of factors in the way we think about underwriting is, we want to make sure that you have a track record in doing something in the development area. I cannot tell you how many managers I've seen come to our office and say, we have a qualified opportunity zone fund, and you ask them to show us their track record around what they have done in sort of development, and they have nothing. Or they've done 2 properties, and their properties were essentially a friend of theirs who built a local sort of house or something like that. So there were a lot of interesting stuff that we saw that just doesn't pass the sniff test. And so where I say the bar is higher, and very few institutional quality managers like yourselves, GTIs and few others that we have partnered with, are one that we can be very happy and excited to partner with. And that matters. You can screw up a variety of different ways, and we don't want our clients to get screwed up on investment on the real estate side.
Thank you for that. The real background to it is we were managing institutional capital for 15 years before this came around, right? So I appreciate the compliment there of being more institutional, but it really actually came from the history. This is not a hobby for us, not something we started just because of the tax break.
And I'm not just saying this because I'm on this panel, by the way.
Well, I would appreciate it anyway.
We have reviewed hundreds of managers in this category.
Yeah.
There are a few that we sort of took a very deep dive on, but I can name those on my sort of hand here, right? Which is there are probably 10 or 11 that we consider to be high quality.
Right. And one of the reasons probably is the fact that this has to be new development, right? You can't buy existing assets for an opportunity zone fund. And a lot of the larger funds out there, Blackstone, Carlyle, Apollo, they buy existing properties. If they have $10 billion to invest, you actually can't possibly shove it down into the development stage because these buildings, they just don't need that much capital. What are you seeing, Jimmy, in terms of what people have invested in and where when it comes to opportunity zones?
Yeah, so I'm going to rely on data from Novogradac, which is a professional services firm that has really deep experience in tax credits, but in particular opportunity zones, and they have actually surveyed qualified opportunity funds. I think they are surveying over 1,000 qualified opportunity funds in their survey these days, which is a pretty large chunk of the market. They estimate it's about maybe a quarter to a third of the total market in terms of total transaction volume that they are surveying. And I think it's about 75 to 80% of the funds that have been raised so far to date have at least some exposure to residential. So that's my long-winded way of saying the by far the most popular asset class for qualified opportunity fund investing is multifamily real estate, some single family in there as well. But just anecdotally, the types of fund sponsors that I work with typically are doing a lot of multifamily. I saw some hotels at the beginning, but then the pandemic kind of did away with the hospitality assets. I don't know that it's too dissimilar from just real estate at large. Fair number of industrial and warehouse deals as well. Actually, I had a question for Kunal, though, if I can play moderator for a second. I wanted to get back to your iCapital platform and ask you, you have, how many advisors did you say?
11,000.
11,000, that's impressive. So, and you have a wide variety of different alternative assets that you list on your platform, probably a lot of DSTs, energy, maybe some conservation easements even. And
not much in energy or conservation.
okay, well, I'm going out on a limb here, but certainly opportunity zones as well. How do these advisors think about when and where to put their clients into opportunity zone products as opposed to any other type of real estate product or other type of alternative asset?
Well, tax is a critical factor of how to think about that, right? So if you have a client who has a decent amount of low-cost basis shares in some other stock, right, or has significant profits, it is very clear that they will look for a certain portion of that capital to go towards opportunity zone, right? So if you're a Moderna employee from 2015, and even though stock has gone down by half in the last 1 year, you still are sitting on a significant amount of low-cost basis, for example, right? And let's say now all of a sudden you decide to get out of it, and you have millions of dollars of gains. It's not unreasonable for that client to consider some portion of that money to go towards sort of opportunity zone real estate transactions. And so it's a conversation, all right? When we have our sales reps call the clients and say, what are you looking for? Understanding their portfolio, understanding their needs, liquidity, and how recent the wealth creation has been will be all of the conversations we'll have, right? And so our team is prepared to position products accordingly. We are not just pushing opportunity zone all day long or DST. It has to be sort of in line with what the market essentially does. The other factor, sort of going to one of the comments that you made about the market though, Jimmy, which is, yes, most clients are used to getting a lot of multifamily, some industrials, but I do see there is a bit of a change happening in people's perception around certain categories right now. And it's partly a contrarian play, but a lot of people think that they feel like they are underexposed right now to segments such as office. For some people, that is a contrarian play, as well as hospitality, right? We have been underbuilding in that area for now many years. Pandemic didn't help. The current sort of inflationary environment is not helping either. But for the long term, most of these assets survive well. And if you find a right zone, you talked about student housing, but there are a lot of interesting sort of opportunity zone development opportunities in student housing for student hotels. You go to many of the major college towns, and the quality of hotels is not there. Mm-hmm. And you have an opportunity to build something there as well. And many of them are opportunity zones because of the income sort of ratio of students. So there are some contrarian opportunities that clients are asking for increasingly. And I think that there are some opportunities that people like yourselves may consider putting them in the portfolio as well.
Yep. And we have done student housing. There is one in the first fund. There will probably be more in the second. To us, it's kind of anything you can live in. And if it falls into a great university campus and there is dire need for housing, it's just an apartment in a different format, but certainly fulfills that niche. Maybe we switch topics a little bit to the format of the funds themselves and talk about diversification versus single deal. What's kind of the landscape there, Jimmy, in terms of single asset versus fund investment?
I've seen both work really, and fund sponsors come to me and they ask me that question, hey, should I pitch this portfolio we have as one huge multi-asset fund, or should I break it up and pitch each project separately and take in money directly into a single asset fund? And I don't know that I have a magic answer, really. I think it kind of depends. Different investors have different needs. If you have some sort of coherent strategy or investment thesis that you can weave across all of the assets, I think it might make sense to do a multi-asset fund. And certainly some investors want to be diversified into, across, maybe it's the same property type, but maybe it's in different locations. Maybe it's in different city blocks in the same geographic location. Either way, you get a little bit of diversification across multiple buildings. But then some investors really want to know which specific building am I going to own a piece of. So I don't really know if I have a really good answer there. There's pros and cons either way, but as an investor, know that you do have options. There are multi-asset funds and there are single asset funds. Oftentimes, a fund sponsor will present a multi-asset fund offering. Maybe you'll really only like one or two of them, one or two of the deals in there. You can oftentimes go to that fund manager and ask them, hey, would you consider a sidecar deal on just this one building or just that building? And it depends on the fund sponsor, and depends on how much you're bringing to the table, but they can oftentimes work with you to put together something where you're coming in just on one deal. That's what I've seen anyway.
Yeah, if I can jump in there, I agree both has worked, and we have seen both sort of kind of deals. Our preference is the multi sort of asset portfolios, a fund structure. It's partly because, again, it goes back to the investment fundamentals, right? One single property risk is much higher than diversifying that risk across multiple properties. If you invest that across 10 to 12 assets, again, if you think from an investment perspective, you're reducing the risk, and that's the number one focus of ours. We also like the fund structure from an exit perspective, right? When you are thinking about an exit of a multi-fund, in your case, a REIT structure, right? You have more optionality. You can sell single individual assets when the tenure expires. You can potentially do a portfolio sale of like 4 or 5 properties together. You can go IPO if the markets are conducive. So there is just far more flexibility. Trying to IPO a single asset or trying to sort of create a sales plan around one asset is going to be very limiting. You are going to have a very finite number of buyers and very finite sale process. So we think the additional optionality is even more important, because we don't know what the speculation, we are speculating about tax laws, what will happen 6 months from now. If we don't know what is going to happen 6 months from now, we sure don't know what is going to happen 10 years from now. Yep. And so why even speculate on the risk there? Let's try to diversify and give ourselves more options and make sure that our clients have the best possible outcome, depending on the conditions at that point. The tax law could change, the IPO market could change, but we know that more options leads to better returns.
Yeah, and the final regs that came out, as I said, in January of 2020, really provided that maximum flexibility, which creates multiple different vehicles that you can have as your investment, single asset, multiple assets, and we've seen all different types, and we deal with people who have specific funds, like you do, Peter. But also people who've raised capital for specific asset deals. And both have raised capital, both have worked from a capital deployment point of view. Obviously, we'll know in time, when we get to the exit, what the end results are on some of these. But we've seen capital flow in both cases, and capital flow efficiently in both cases.
Peter, I've got a question for you.
Of course.
Actually. I like playing interviewer sometimes, so.
You're the professional.
I caught a lull in the conversation.
Definitely.
I want to hear, what pushback do you get from your investors regarding the Opportunity Zone rules, the platform itself, especially the 10-year hold, and how do you reframe that for them potentially? Because I think the 10-year hold oftentimes is looked at as a hindrance, but I think it could be kind of turned on its head and looked at as a big benefit potentially sometimes.
Yeah, and That is most often the question. It's easy to get into these, it's harder to get out. And a 10-year time frame, it passes quickly, but seems like a long time. And my answer actually to that usually is that the government is paying you for that. The underlying investment, the real estate, is what needs to make the return, and hopefully it's an opportunistic type return commensurate with the risk of development, which is what we're doing. But normally we would exit out of an investment like that in 4 or 5 years when the asset is completed, leased, what we call stabilized, and sold. And that should deliver a 17-18% IRR, 1.8 times equity multiple. But with this legislation, we have to hold it for another 7 or so years. It's a different asset because it's a core-like property that has already been built, doesn't have risk in it. You know what the yield is, so usually people pay something like 5 or 6% for that. And if you add 17% return over the first 5 years and then 5% return over the next 7, you kind of come up with the return profile of this investment, which is 12 to 14% IRR. Now, when people say, when they look at that and say 12, 14%, 10-year horizon, it seems, I should maybe be getting paid more, and that's when the government comes in. The compensation for that long-term hold, for that illiquidity, and for locking you up for such a long time is that 3 or 4% incremental IRR that you get by not paying taxes. So if you get a nice double-digit return over a decade, compounding is beautiful, right? You can almost triple your money if you grow something 12% over 12 over 12 for 10 years. But you have to wait a long time. They add about 3 or 4% to that, and to me, that's a fair compensation.
Yeah.
So that's my answer, and it usually just goes back to, okay, well, what are the other risks? And that's development risk, but that's a different fundamental area.
Sure.
I can jump in to
Yeah.
answer some of the one question as well, which is, we are on our platform, we have 10-year products available all the time, right? When you invest in traditional private equity, real estate, distress opportunity. So for our users, that's never been a big issue. When they come to our platform, they expect the investment vehicle will be sort of long duration. The only caveat we have to present is there is some income coming from this, but there is no liquidity that will come. So the liquidity is more back-ended, whereas if you invest in buyout or venture capital strategy, you may get some liquidity starting years 4, 5, and 6. That's an education, but to your point, that's the only way. If you want to save money on taxes, and to your point, government is paying you for that, this is the only way to do it. And so most people are fairly okay with that, as long as they put less than 1% of the portfolio, right? If you're a $10 million capital, you're not putting $1 million here. You're oftentimes putting $100,000, maybe $200,000 capital.
Sure.
I think the other thing that it was embedded in what Peter was saying is, we always talk about the gain being eligible to be excluded. The other part is it's not only the gain, it's the depreciation recapture. So when people ask the question they had to Peter is, yeah, you're holding this for a longer period of time, but you're basically, for those extra years, getting tax-free cash flow. When we've modeled these out for the last 3 or 4 years, especially in the multifamily area, what we end up telling people, and usually people step back and take a second, we said your pre-tax IRR is 12 and your after-tax IRR is 14. There is potentially in most of these deals absolutely no tax, not only on the appreciation, but on all your rental income and cash flows. And that's kind of an element that people don't think about, is the entire investment is potentially completely tax sheltered. And it comes out, in the models we do in the multifamily area with the depreciation, because you don't have to recapture the depreciation. That is also excluded on the back end. So yeah, you may have to hold it for a longer period of time, but basically you're holding it in a tax-free bond for years 5, 6, 7, 8, 9, 10.
So we have about 15 minutes left. Jimmy, have we missed a question that you usually ask in your panels, or?
Well, I want to talk about one more thing maybe before we turn it back over. So we've seen a market drawdown in the past 9 months or so. I don't know where GTIS gets a lot of its opportunity zone investors. For other types of real estate tax programs. By the way, we kind of glossed over the fact that qualified opportunity funds can invest in businesses as well. But the fact of the matter is the vast majority of qualified opportunity fund investing is done through real estate. So maybe we can talk about business on a different panel a different day, or you can come find us afterwards and talk to us about it. But you don't necessarily have to have gains from real estate to do opportunity zone investing.
Right.
Oftentimes you'll get stock investors to come in, which kind of provides them with a nice diversification method. They can get diversified away from the stock market and into potentially non-correlated real alternative asset like real estate, right? Have you seen those types of investors, the capital coming in, shrink a little bit over the last few months? Or is that a concern of yours going forward because of the drawdown in the broader stock market?
I wish I had a crystal ball here. We have not yet, but speaking of a 6-month window, we are seeing investors who are deploying gains from March and April, and if they were smart and took some chips off the table, they're looking at pretty sizable gains. It's only 6 or 7 months since we had a record stock market. It's unbelievable what's happened. So I'll punt on that answer.
Maybe
because
it's a
I don't
lagging
know.
indicator, right?
It certainly is a lagging indicator, and we might start seeing much lesser flows as the gains dissipate, frankly, starting in May, June. But we had a great start to Fund 2 and have enough capital to deploy it in a diversified manner. It had a bigger initial close than the first fund. So I honestly don't know. But I would not be surprised given the drawdown. A lot of our capital sources came from equity markets. And yeah, you're not looking at a ton of gain lately. There are other sources. We're seeing business sales that either happened during the peak or are still happening, and you have well over a year to deploy that. If it comes on a K1, and Joe maybe can speak to that, you have plenty of time. It's not just 180 days like with stocks or bonds. If you sold real estate, really anything that comes on a K1, you have well until next year, even if it was done several months ago. So we're still seeing that, business sales, but a lot of the gain came from equities, and that's one of our frustrations with the program. Everything was really quite smart and well conceived in the original legislation, except for this one thing, actually two. One, why did they have to say that it's got to be gains, right? Why can't it just be free cash that you could invest for these communities and support them? And the other frustration is they said it has to be invested within 6 months. The word invested has caused so much heartbreak and misery because it should have said committed within 6 months. Developments do not invest money in the moment of time. They invest over time. And if they only had said commit within 6 months of gain, we would have plenty of time to call the capital. We can't do that. We have to take the money right away, day one, because the word invested, as the Treasury has interpreted it, means it's got to be put into the QOF on day one. So those two frustrations with an otherwise very innovative piece of legislation and a great program. Let's then switch to the audience. If there are questions.
Can you repeat his question?
Repeat the question just so everyone.
Yeah, I think you're saying the new legislation that's potential, would it be retroactive for investments that were made? The answer is it would change the time period of when the deferral would be. So by changing the time period, investments that were made in 2021 where people did not think they could get any of the reduction benefit, they would get the reduction benefit. So the way they would change it would be any investments made prior to December 31, 2022 would get a 15% reduction. Any investments made from January 1, 2023 to December 31, 2023 would get a 10% reduction. But everything in the past, if you invested in 2021 and you said, oh, I missed the reduction, you would be able to get that back. This is what was a phenomenon that happened in 2021, December 31, 2021, I think you experienced this, is because the 5-year period was expiring, a lot of people wanted to put their money into funds on December 31, 2021.
There was some urgency to get it done.
Yeah. We may see that again. If this legislation gets passed, there will be, I think, people running to get their gains in on December 31, 2022. Now,
Assuming it gets passed this year.
so he gets past this year. That marriage that Peter talks about of, hey, if you got K1 gains, you got extra time. That is correct if you've got K1 gains. But the K1 gains will start December 31, 2022. So if you had a gain that happened in earlier part of the year, that will be the first day you could invest it from a K1 point of view. And we saw this phenomena happen in 2021 when people were rushing to get their investments in on that specific date, which is the first day they could put it in. And I think you probably experienced a lot of people putting money into your fund on that specific day of the year.
Yep. I'll repeat the question. If you are a New York resident today, and New York is not a participating state, meaning you cannot use your New York state capital gains because they opted out of the program, unfortunately. You can only use federal gains. What happens if you now move to Florida in the intervening period? I'm assuming in the next couple of years. How does the deferral play out in 2026, as well as, I guess, the final gain exclusion if you become a Florida resident? Is New York state coming to get their taxes? You paid New York already.
Yeah, I think
what happens?
Florida's okay. Okay, it's more if I think you move from, like, let's say New York to Massachusetts. Okay, there you paid gains for New York purposes now, and now you become a Massachusetts resident. You have deferred gains that you're picking up on your federal return. You know, are you paying it twice? That's, I think, the big question. I think it's going to be answered. I think states are more concerned of like the opposite, where you defer taxes in a state like Massachusetts now, and you quickly move to Florida, and Massachusetts says you deferred it in 2022, and now you're a Florida resident in 2026. You know, the rules on this haven't caught up from a state point of view. The only thing that's equivalent is there are certain rules around deferred comp of when you earn comp in a state and then you move to another state. Most states have not applied that yet. So you can theoretically defer your gains and become a resident in another state. And if you're a resident of Florida, when that income's recognized, you may not pay any state tax on it. Mm-hmm. I would think that some of the states may start to maybe say if you leave the state, you're going to have to pay tax on this or do something. But right now, you can slip through the cracks, I guess is the best way to describe it.
California came up with a plan to tax people on exit. This would be one of those that they could
conceptually
pick up,
1031
right?
exits.
They would say you invested when you were a resident in California.
Correct.
So 10 years from now,
Yeah.
you know, California, I wouldn't be surprised if they come up with something that knocks on your door, that you invested back then, you now have a...
Now you have to pick it up,
Yep,
yeah.
yep. Any other questions or anything in your sleeve of questions, Jimmy, that we have just
4 minutes.
2 or 3 minutes left?
Oh, we
do?
let's do an audience question there.
I'll repeat the question. Speaking of the proposal that would pair the extension with the recalculation of zones and potentially creating some new ones while taking some away, has anyone looked at the actual creation of employment opportunities and all the criteria that the government wanted to advance with this program? Obviously, they're giving a big tax break. They want the communities to grow, not just the managers to make a nice return. I'll give a really short answer is not really at the government level at all. There just is no lever right now. They don't even have the data reporting, and that's part of what they're trying to fix with this extension, that we would be required to report. But we as managers have long ago volunteered to do that. So we are tracking. If you look at our ESG report, we have a sustainability report for the fund last year. We have one coming out in the next few weeks. We are already tracking all the employment statistics, poverty level, job creation. Our funds in the past have been ranked at the top of the GRESB survey, so we review the environmentals very strictly and look at things like water usage, power efficiency, waste, and all of that. It's in the report, and we are doing it for our zip codes, for our census tracts as to what the improvement has been. I can say that it's already improving. Maybe that's a factor of where we've invested or the economy. No one's aggregated that. As far as I know, there's not been a comprehensive study of the impact of these zones and what then might result in redistribution of zones, because maybe some of them are not fulfilling the spirit of the program.
Right,
Have you seen
right.
any?
Well, I can add to that a little bit. So yeah, any really good qualified opportunity fund manager, and Peter and his team at GTIS are doing this, they are getting ahead of the legislation. They're already doing some level of impact reporting or transparency reporting to show that they're creating X number of jobs or Y amount of economic impact or delivering, a certain uplift in the local tax base in these communities that desperately need this private capital to flow into it, for a couple of reasons. One, because they want to be ready when this legislation is passed. Two, they want to show their investors that they are doing the good that the legislation intended. And I think the third one is we want to tell success stories as an industry so that Congress has some reason why they would want to extend the program. But there is one study that I've seen by a couple of professors out of Cal Berkeley, if I recall correctly. And it's called, let's see, the last names are Kennedy and Wheeler. And they had access, they work with the Joint Committee on Taxation. So they were able to get access to aggregated QOF Form 8996 data for the first couple of years of the program, 2019 and 2020. Their overall review of the program is rather unfavorable, unfortunately. I think they had a agenda going into it, I suspect. So their review of the program is a little bit clouded by that. But there is some good data in there that they were able to pull out and some good insights in there if you want to look that up, Kennedy and Wheeler, that study. Yeah. Anything else that comes to mind for you? Or?
No, the only thing I think I wanted to add real quick is, when the program came out, it had these disadvantages, and it was, your capital had to be patient. You had to have less debt, more equity. You had to have a 10-year hold. And I know in all the presentations for all your people this morning, Peter, those themes came out as kind of how you're looking at making current real estate investments that have a little bit less leverage, a little more patience, a little less downside. And it would seem, if those themes are going to play out in the next couple of years, qualified opportunity zone investments in real estate are marrying up a little bit more with the way the program's designed, of how people want to deploy their capital. So what was, probably 2021, 2022, hey, we want to be able to, get out early. It's got too long of a hold. It's got too much equity versus debt. All those things now seem to be more positively spun in all of your real estate investments, and all those themes came out in all the earlier sessions today.
It's true. I think investors have really appreciated the low leverage that we're deploying with our investments conservatively. And that's something that came from the last crisis, from the GFC, when you could have levered something 80%. That debt was available back then, but then prices dropped 30%. And if you had 80% debt and your value was at 70, the 10% is when the bank came and took your asset. And you had never had a chance to recover if you went through a foreclosure. If you kept your debt at how we do it at about 50, it wasn't a great time, but we got through it, and it took about 2 years to come back and another 2 or 3 years to then double the values. So if you can survive these turbulent periods, I think it goes back to Mohamed El-Erian's, I love that saying, you just can't make a mistake that's fatal and that ends the course, right? It applies to real estate, just avoid those kinds of mistakes. I think we just about took our time. Our panelists will be around for a little bit, so if you have any additional specific questions, please find them. We are going to now move to review the performance of the first fund. So I'll invite my partner Amit here and thank our panelists for being with us this afternoon. Thank you so much.
Thank you.
Thank you.